What truly defines success in long-term investing? I mean, is it really about relentlessly chasing those high-flying gains, or is there something else, maybe a different metric, especially when things get, challenging?
Well, it's a fundamental question, isn't it? It often separates, I think, the seasoned investors from those still figuring things out.
Right. Do you follow the herd, or do you actually commit to a philosophy, something that prioritizes consistency, maybe resilience above everything else?
Exactly. And that really gets to the heart of our deep dive today.
Yeah, our source material is, well, it's pretty remarkable. A letter from July 1962, written by the legendary Warren Buffett to his partner.
Mhm. And it's not just some dusty old document. It's a rare window, really, into a master's thinking as he was navigating a particularly tough market.
A really tough period. It gives incredible insight into how he communicated his core principles, his expectations, which must have been crucial when his partners were seeing all that turbulence, right?
Absolutely vital. So our mission today is to unpack this letter.
Let's dig in. We want to extract those timeless principles, this investment philosophy that champions consistency and, crucially, relative performance, not just absolute gains.
Yeah, we'll explore how these ideas were really put to the test in that first half of 1962.
And the lessons that came out of it, which are still relevant for anyone looking to, build real wealth through market cycles. Let's dive in.
Okay.
So one of the first things that jumps out in this letter is how Buffett starts. Right off the bat, he talks about market predictions, or maybe his lack of them.
Yeah. He says quite bluntly he doesn't have the faintest idea about short-term market or business forecasts.
What does that tell you right at the start?
Well, it's fascinating, isn't it? The transparency, the humility. He's deliberately stepping away from that crystal ball gazing that so many investors feel pressured into.
It immediately sets a very practical, grounded tone for everything else.
Totally. It sets the stage for a long-term mindset.
Right. So while he avoids predicting next quarter, he does give a sort of decade-long outlook for the general market.
Uh-huh. He anticipates a mix.
Mhm.
Some years up 20–25%, some down by a similar chunk, and most kind of in the middle.
And he emphasizes the sequence doesn't matter for a truly long-term investor.
Which connects this idea that market volatility isn't some weird exception. It's just part of the deal. It's a constant.
So what was his expectation for the Dow Jones Industrial Average then, over a long haul?
He was looking at compounded returns of about 5% to 7% per year. That's from dividends and market value gains combined.
Okay.
And here's a really critical warning, still relevant today. Expecting substantially better than that from the general market, you're probably setting yourself up for disappointment.
That sets a pretty clear baseline, especially back in 1962. But then he introduces the partnership's unique objective, and this is where it really makes you stop and think.
Yeah, the core mission, as he states it, was to pile up yearly advantages over the performance of the Dow.
Without worrying too much about whether the absolute results in a given year are a plus or a minus. I mean, that's not just a small difference, it's a fundamental shift in defining success.
It completely flips the script on what many people chase. And he gives this powerful illustration.
Which one was that?
A year where the partnership is down 15%, but the Dow drops 25%, he calls that much superior to a year when both just advanced 20%.
Wow. So it's a relative outperformance, especially in the markets getting hammered. That was their real focus.
That was their North Star. It's not just about making money. It's about how you do compared to the benchmark, particularly when times are tough.
And he even hammers this point home, saying partners needed to get this not only in your cerebral regions, but also down in the pit of your stomach.
Yeah, that's deep conviction he was asking for. It speaks volumes about the psychological discipline needed to actually stick with the strategy like that.
So then he gets into specifics.
He does. He lays out what he calls rash specific expectations for their relative performance, admitting, there's a high chance he could be wrong.
Okay, so what were they? Particularly in bad markets.
Well, in a declining market, and he thought there was a high probability of a big drop, maybe 35–40%, sometime in the next decade, the partnership hoped to be down only 15–20%.
So significantly less than the market, like a cushion.
Exactly. He implies it's a considerably more conservative vehicle for investment in stocks.
Interesting. So it sounds like a strategy really built for rough seas. But what about when the markets weren't tanking? What did outperformance look like then?
Well, in static markets, if the Dow was basically flat, the partnership aimed to be up about 10 percentage points.
Okay, still a nice edge.
But, and this is key, if the Dow surged 20% or more, he expected the partnership would struggle to be up as much.
So they wouldn't necessarily capture all the upside in a roaring bull market.
Probably not. The takeaway is he wasn't just predicting volatility. He was building a philosophy designed to handle it, knowing that long-term consistency beats short-term bursts.
And the compounded goal, based on hitting those relative targets, is pretty impressive. If the Dow does its 5–7%, the partnership was aiming for what, 15–17% per year?
That was the goal, a significantly higher return built on relative strength. He even adds a little note that these expectations might look very much so when viewed from the vantage point of 1965 or 1970, just acknowledging how bold it sounded.
It's a really bold, long-term vision. Okay, so with that philosophy laid out, the real test arrived pretty quickly, didn't it?
Oh, yeah. The first half of 1962, a major challenge for investors.
All right, the Dow plunged from over 730 points at the end of 61 down to around 560 by mid-62.
It was absolutely a trial by fire for their approach. If you just held the Dow index during that time, even with dividends, you were looking at a loss of 21.7%.
Ouch. The letter spells that out clearly.
It does. It shows just how tough that period was.
So the big question, how did the partnership hold up under that kind of market pressure?
Well, the letter reveals their performance before any payments to partners was actually a minus 7.5% for that first half.
Minus 7.5% versus minus 21.7% for the Dow.
Exactly. And this is where the philosophy really proves itself. They gained, as the letter states, a remarkable 14.2 percentage points advantage over the Dow.
That's huge in just 6 months.
It is. And he explicitly says, a declining Dow gives us our chance to shine and pile up the percentage advantages.
So it worked as designed.
Pretty much. He even notes their target was roughly for the partnership to decline about 0.5% for every 1% the Dow fell. So this result was right in line with that goal. It was capital preservation in action.
A really stark illustration of how the strategy was meant to excel when others were struggling. But even with that strong relative showing, the letter includes an important warning. Right?
Yes, a crucial caveat. He reiterates that 6-month or even 1-year results are not to be taken too seriously.
Why be cautious even after such a, well, seemingly successful period relative to the market?
Because short measurement periods can exaggerate chance fluctuations in performance. He acknowledges this half was unusually good, but periods of doing relatively poorly were bound to be.
It's that long-term discipline again. Resisting the urge to celebrate too early or despair too quickly.
Precisely. It reinforces his core belief. Build wealth by ignoring the short-term noise.
So this performance naturally leads to the question, how did it compare to other professional managers at the time? Buffett seemed to think the Dow itself was a tough benchmark to beat.
He really did. He called it no pushover. His view was that most funds, investment companies, counselors, bank trust departments, even DIY investors would likely end up with results roughly comparable to the Dow.
And if they deviated?
He thought deviations were much more likely to be toward a poorer performance than a superior one. Pretty stark view of the industry back then.
So he's saying the bar is high, and most pros aren't consistently clearing it. And to prove his point, the letter constantly compares the partnership against major funds, right?
Yeah, the 2 largest open-end funds and the 2 largest closed-end ones. And he notes their multi-year results, shown in an appendix, were extraordinarily close to the Dow's.
Okay, so how did those guys do in the first half of 1962, that tough period we just talked about?
Well, this is really illuminating. Those prominent mutual funds actually did worse than the Dow.
Worse? Really?
Yeah. Massachusetts Investors Trust, a huge fund, had an overall decline of 23%. Investor Stock Fund was down minus 25.4%.
Wow, so they underperformed even the falling market.
And it wasn't just them. He cites a Wall Street Journal article from June 62 titled Funds versus Market. It found that all 17 large common stock funds they looked at had records poorer than the Dow from its recent peak up to that date.
That's a powerful indictment of the supposed experts back then, and he gets even more specific about the growth funds, doesn't he?
He does. He highlights that these so-called growth funds were, almost without exception, particularly hard hit, down considerably more than the Dow.
Why was that?
Well, think about what growth often meant, that maybe higher valuations, more sensitivity to market sentiment shifts. And he gives examples. 3 big growth funds with great records in 59-61.
Fidelity Capital, Putnam Growth, Wellington Equity.
Right. They averaged an overall minus 32.3% for that first half. Significantly worse than the Dow's, minus 21.7%.
And here comes the real kicker, the irony, he points out.
Exactly. Their great performance in the few years before 1962 caused a rush of new investors into those funds.
Ah, so people piled in chasing past returns.
Just in time to experience the really poor 1962 performance. So, very many more holders, as he puts it, suffered the 62 losses, then had enjoyed the earlier good years.
Oof. That's a classic behavioral finance trap, isn't it? Bad timing driven by performance chasing.
Perfectly illustrates his hypothesis.
Right.
You must judge investment performance over time through a full cycle of ups and downs.
Right. As he says, there will continue to be both, a point perhaps better understood now than 6 months ago. A bit of dry wit there, maybe?
Maybe so. It's a fundamental insight. You need to see how a strategy holds up when things get rough, not just when everything's going up.
And the reason he spent so much time comparing his results to these big funds wasn't because he ran his partnership the same way.
No, not at all. It was because these funds represented the public batting average of professional, highly paid management handling huge sums, $20 billion, he cites.
The implication being his partners might have otherwise put their money there.
Exactly. It provided really powerful context for the partnership's relative outperformance during that difficult period. It showed why his different approach mattered.
Okay, so we've covered the philosophy, the performance tests in 62, the comparison to peers, but what about the practical side? How did these results actually hit the partners' accounts and the partnership's operations?
Right, the nitty-gritty.
Hmm.
The letter clarifies that all the performance numbers we've discussed are before any allocation to Buffett as the general partner or any monthly payments to the limited partners.
And there was a specific rule about that allocation to him, wasn't there?
Yes, a key structural point. No allocation was made to the general partner unless the overall yearly results were plus 6% or better.
And if they fell short?
Any shortfall was carried forward. So if they only made 4% one year, he'd need to make 8% the next year before getting his share above the 6% hurdle.
That really aligns his interests with the partners, doesn't it? He only does well if they do well first, above a certain threshold.
Precisely.
Yeah.
Strong performance was baked into the structure.
So for the partners themselves, how did that tough first half impact their actual equity?
It varied slightly. For partners who weren't making withdrawals, their market value equity decreased by that 7.5% we mentioned.
Okay, matching the partnership's overall result.
But for partners who were taking withdrawals, typically at 6% per year, their market value equity went down by more 10.5%.
Because they were taking money out while the value was falling. Makes sense.
Right. And this led to another important point, future payments.
Ah, okay. What happened there?
The letter explained that if the full year's results ended up below that plus 6% hurdle, which he said looked very probable unless the Dow rallied significantly, then the monthly payments for the next year would be proportionately reduced.
So the income stream wasn't guaranteed at the initial level if performance dipped.
Correct. It adjusted based on the underlying capital value. He even gave a very clear example to, bring it to life.
What was the example?
He said, imagine the overall results for the full year were minus 7%. A partner who started with $100,000 on January 1st would see their equity drop to $87,000 by December 31st.
How's that math work?
It's the minus 7% performance hit, $7,000, plus the $6,000 they received in monthly payments throughout the year. $6,000 initial equity, or $500 a month on $100K. So $100,000, $7,000 minus $6,000 equals $87,000.
Got it. And the consequence for next year's payments?
Their monthly payment would drop proportionally. Instead of getting $500 a month, 6% of $100K annually, they'd now get $435 a month, which is 6% of the new $87K equity annually.
Wow, that's incredibly transparent, managing expectations very directly about how performance impacts income.
Extremely pragmatic. And he also briefly mentioned that any advance payments partners received in 1962 just earned a straight 6% interest and didn't share in the partnership's profits or, importantly, its losses. Just another detail clarifying the mechanics.
It really paints a picture of a very clear, no-nonsense approach to managing the partnership and communicating with partners, especially during challenging times.
Definitely.
So, wrapping this up, what does this deep dive into Buffett's 1962 letter really mean for us, for investors today?
Well, I think the core lessons are just incredibly valuable and, frankly, timeless. The huge importance of adopting that long-term relative performance mindset.
Yeah, not getting whipsawed by short-term absolute gains or losses.
Exactly. And it really drives home that outperformance often comes not from catching every wave in a bull market, but from, disciplined capital preservation, skillfully navigating the downturns.
That's where the real advantage seems to be built, according to this philosophy.
It seems so. And critically, that investment results must be judged across full market cycles. You need the ups and the downs to get a true picture, not just focusing on isolated good periods.
Right. This historical perspective from way back in 1962 really redefined what success looked like for Buffett and his partners then.
It really did.
So, Given everything we've talked about, the final thought for you, the listener, is maybe this. How does this redefine your own understanding of what success means in investing, especially when the market inevitably faces tough
Yeah,
challenges?
what yardstick are you truly measuring yourself against? Is it just the absolute number or something more robust, more like what Buffett outlined here?
It's definitely a question worth reflecting on.